And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. With the S&P at new highs, along with all the new ETFs associated with that index, what's next for ETFs? Let's chat with Ann Bartels. She's the head of ETF strategy at Bank of America Merrill Lynch Global Research. Tim Seymour, founder and CIO of Seymour Asset Management. Tim, what struck me is this whole defensive ETF sectors, how they've been leading. Utilities, REITs, consumer staples, they've been the leaders since the old highs in July. Are we going to see defensive leading going into the end of the year?
Well, look, what's fascinating about where we are right now, not because it's a new all-time high, but the breakout of banks, if you look at financials, they're kind of getting back above that long-term moving average, which gives you some sense of some confidence in the move, although we've been here before. Emerging markets, the EEM has been sideways basically for 9 to 12 months, but it looks like it's starting to break out. And then the other cyclical parts of the world. So look at the DAX and look at the EWG, which is a way to play that. So there, if ETFs are telling a story, I'd first look at the SMH, which is the semiconductors, and then I would look at the more either late cycle ETFs or exposure to the underlying and say that this isn't just about a defensive rally that I think is what we saw back in July.
And Ann, it's true, semiconductors have rallied, but that's an anomaly amongst the cyclical groups. The more traditional, the deeper cyclical groups, the industrials and the materials, they've been lagging, and that's sort of the natural thing if you think the global economy is not going to go down notably. What's your thoughts on this?
That's correct. We do like cyclicals here, especially if we're going to get a year-end rally, and we're starting to move into one of the most positively seasonal periods within the market. The market has been faced with a lot of challenges, really hasn't been going down, and as you said, the defensive have led, but we find better valuations sitting in the cyclicals, and we still like semiconductors, and we like also the SMH.
So in 2020, you're not in the recession camp. You don't see that. Do you see a slowdown? What's the reason behind buying cyclicals just because they're underperforming?
Because we don't see a recession. We've only put that at 30%. We do see, modest growth. And in a modest growth environment with the valuations where they are, we think cyclicals are more attractive than the defensive space.
All right. Go ahead.
Yeah, just simply, and they were much maligned and priced that way. That violent rotation we saw, though, into these same industrials in late August is happening again, and I think that's why this feels a little different.
All right, let's move on. A subject very dear to my heart. The first space company's gone public right down here at the New York Stock Exchange. Virgin Galactic listed at the NYSE this morning, but there are already several space-oriented ETFs out there. The biggest one, if you consider it a broad group, is the iShares Aerospace and Defense Group. That's up 27% this year, but there's other space-oriented ETFs out there as well. Obviously, space is a little bit of a subset of aerospace and defense, but you've written about the ITA, the big aerospace ETF, and you're bullish, even though it's up 27% this year.
That's correct. It's our top pick. Boeing is a heavy weight in it, though. It's over 20%. But we overlay Bank of America's fundamental views based on our analysts and roll it all up. We also do technicals and we do efficiency, and ITA becomes our top pick. But you really have to be careful what you own. If you go into the PPA, you'll get a different basket, and Boeing will only make up 6%. And if you go in the XAR, Boeing doesn't even show up in that basket.
Well, we talked about this over and over again. The viewers say, okay, so which one do I pick? And I guess it depends on, are you happy with a concentrated group like the ITA? 50% of the ITA is 5 stocks. Yeah. Boeing, United Technology, Lockheed Martin, and Raytheon. Is that a good thing or a bad thing?
Well, they trade together, and if you look at defense at different times over the last 5 years, they've had significant outperformance and have kind of re-rated. Personally, I believe owning Boeing in this environment is part of, tactically where I would want a heavy weighting in my ETF, just because I think Boeing is still a free cash flow story. Right. Yes, we have a lot of regulatory issues in the timing of the MAX back online, but I want Boeing here.
But you're speaking to a very specific sector here in terms of aerospace. Generically, is it better to own an ETF that has a strong concentration of 50% with 5 stocks, or is it not better, or does it depend on the sector?
It really depends for me. When I'm looking to get subsector exposure and have some concentrated play on either a reacceleration in the economy, a reacceleration in a sector where you started to see a re-rating, I want to be more concentrated. I mean, my view on index ETF ownership is it's really about participation as opposed to really being tactical.
Ann, it's interesting to watch the ETF community try to cater to the space community, because there's a lot of interest in this out there. Some new ETFs that have the word first, Final Frontiers in them. ROKT just launched a little while ago. Spider S&P, Kensho, Final Frontiers, ROKT. It's got L3 Harris, Teledyne, Raytheon. It's kind of like the aerospace group, but they're calling it Final Frontiers.
I keep wanting to say that the new frontier. Can
yeah,
you say
this is Star Trek.
Star Trek.
So they're just repurposing this. Instead, we're not calling it defense or aerospace. This is the Final Frontier.
Yeah.
And you can see the interest level in this.
You can still bucket it under aerospace and defense. And what's interesting, in a slow economic environment, defense does well.
Yeah.
Presidential election, defense does well.
Yeah, and there's another one just started, Procure Space ETF. I love this one. This is UFO is the symbol here. And it's basically, it's a satellite price. They all own satellites, and their attitude, and there's something to be said, the back door into space is satellites.
It's a utility. It's the utility of tomorrow, and that's a very interesting way to get exposure right now.
Yeah. Let me move on here. Consumer discretionary has lagged recently, and you can blame Amazon for that. It has the third largest market cap of any company, and it can move indexes and ETFs. This was a big topic last week. Amazon's poor guidance directly impacted the whole consumer discretionary space. Marianne, this is another good example of know what's in your ETF, because the largest consumer discretionary ETF, what, Amazon's 22% of it? There it is, XLY.
XLY.
That's 22% Amazon.
And this is why you want to be sensitive to what you own. If you want to own Amazon, then you want to own XLY. But if you don't want to have Amazon, you want to own FXD.
FXD being
the first trust consumer discretionary. So these are the consumer discretionary.
And is that weighted by the FXD is weighted? How is that weighted?
Well, it's a first trust. They tend to take more of a value approach in designing their baskets, and in taking more of a value-based approach, Amazon doesn't fit into their basket, but they still label it a consumer discretionary or consumer basket.
And so here we get back to that we're back to the same question again. This is that danger of owning a sector where you got a heavy weighting. It hurt consumer discretionary last week with Amazon.
And there's always the existential question of what is Amazon, right? Because I mean, arguably the beta.
You're saying it may not even be consumer discretionary.
Well, I mean,
something
AWS
else.
has really been where the marginal growth has come from, and if you think of the sobering kind of outlook they get, it's not. And so, how about iBuy or something that gives you exposure to the online retailers, those that are a little bit more higher margin?
So the answer is you have to decide what you want. You have to say, I want exposure to data centers, for example, and I may want to own this part or this part, but it's very hard to get pure plays in a lot of these things. But it's really important mentally. This is my answer to people. This is the biggest question I get. What should is it better to own single, small, narrow sectors or bigger sectors where there's 5 companies that are 60% of the ETF?
Look, as a fund manager,
know what you want to own and then go find the ETF. Don't do it the other way around.
I think as a fund manager, if you're trying to express a particular theme, if we're talking about space and we're talking about the infrastructure around towers and truly some of the technology, I think you go after those individual names. But if you truly want exposure to broader tech, I think ETFs are phenomenal.
Let's move on. Bond ETFs, continuing to see inflows. This is amazing to me. Total ETF assets under management are continuing to grow. They've got about $4 trillion in US-based ETFs right now, despite the fact that the broader equity markets are up roughly 20% this year. Inflows into stock ETFs, they're essentially flat this year, but investors continue to put money into bond ETFs, which are growing at a double-digit pace. How do you explain that? We have been talking about this for years now. Well, it doesn't make a lot of sense with the levels, with dividends at these levels, and yet they keep putting money in.
Well, if you talk to financial advisors and if you talk to clients, you'll understand why. There's still a lot of fear and a lot of caution in the marketplace. We also do the Global Fund Manager Survey, and this is really looking at professional fund managers on a global scale, and they're very defensively positioned, which is amazing that markets are hitting all-time highs, and the market all year has had a very defensive position. So that's basically the explanation.
So that's the answer. This is part of the whole defensive posturing that fits in with, underweight industrials and materials and overweight utilities?
It's been the pain trade, and obviously we've had a question about the global growth environment, which has made it very comfortable for people to fly into fixed income instruments. And it makes it so, I think that the ETFs around that community do need to have, greater, access points for people to be investing in munis and AAA credits that actually could be more defensive.
Biggest single question that I get, other than what ETF should I be in, is should I continue to hold on to my high yield ETF? They love that 5 or 6% yield they're getting in HYG and all the other high yield ETFs. Thoughts on this? This is a credit play. If the U.S. economy slows down, the consumer slows down, they're going to be weaker. But what do you tell clients?
So we're still bullish on high yield, especially because we think we're going to stay in a low rate environment. We're not moving towards a recession, so we're willing to take the credit risk to go into high yield. But what's interesting is if you take bond returns on a risk-adjusted basis, they don't look as attractive as equity returns. And that's
Go ahead.
No, that's what we think clients aren't looking at, is their risk-adjusted returns.
10 seconds on high yield, anything?
I tell you what, the J&K and the HYG, if we start to see any questions about the economy, liquidity dries up very quickly in high yield, and I think they will move to the downside.
Good point. China's economy may be weak, but Chinese consumers, they're still buying. It's been a good year for solar stocks, been a good year for home construction, semiconductors as well as that. What do you think here is going on? So the biggest movers this year, solar stocks up 80%. Home construction up 50%, semiconductors up 40%, and by the way, Chinese consumer staple names, I don't have it up here, is also up very big. Chinese consumer names, just US-China companies doing well. Here's what we've got here. Any thoughts? Home construction makes a lot of sense to me.
Well, when I think about what's going on in China, I also think about where we priced expectations for the Chinese economy. We've seen the Chinese government come in with both stimulus, triple R cuts, and I think there is a broader consumption trend going on in China. People forget, although we think it's this big industrial and commodity economy, consumption in China has moved from about 30% 10 years ago to about 40%, and it's moving higher. So the Chinese consumer has been more resilient here, and they're not quite the U.S. consumer, but they're getting there.
10 seconds.
Even with all the trade issues, semiconductors are in a secular bull market. A lot of volatility with them on the upside and the downside, but we think there's still a lot of return.